Welcome back to another episode of What's on Your Mind. And if you're new to the show, what we basically aim to do here is provide you guys, the viewer, with a bit of insight into the processes that professional traders and portfolio managers go through. And to that end, we've got ITPM senior trading mentors Jason McDonald and Ben Berggreen joining me today. Gents, fantastic to have you on the show again. Let's get stuck in. And Jason, you can start things off today.
Yeah, hi everybody. Good to be here again. Yeah, so being based in the UK, for those of you who aren't, you may have missed that we have a new Prime Minister, and we've got a new Finance Minister that we call the Chancellor of the Exchequer, and essentially they came out with a mini budget a couple of weeks ago, and since that moment in time, we've had some severe dislocation in the longer dated UK government bond market, which are called gilts. But that's not what I want to talk about, actually, just briefly, because I think that's been fairly well covered. It's been around now for a couple of weeks. But it kind of occurred to me that that this isn't the only fixed income market where we're seeing what we could call dislocation and signs of potential stress. I add potential. So one thing I did pick up on as well in the US was particularly looking around the high yield world, that in terms of issuance, they just experienced their weakest September since 2011 in terms of high yield issuance. So to kind of give you an idea on the context, for the whole of 2021, US high yield issuance was up at $458 billion. So obviously that's about $500 billion. In 2020, it was $432 billion. Don't forget that's the year of COVID. Year to date, we're at $87 billion. So in other words, that market has severely dried up. You saw at least 10 global bond deals being either delayed or completely shelved last month, according to Bloomberg. And the ICE Bank of America High Yield Index effective yield is now 9%, which is more than double where it ended last year. Now, even Moody's are kind of getting the memo here a bit. They were saying last week that this is quoting them, evaporating issuance will erode corporate liquidity conditions, I think it already has, igniting defaults. So they're now using as a baseline scenario a high yield default rate of 4.4%. That was less than 2% 12 months ago, and the long-term average is 3.7%. And they also added that under a moderately pessimistic scenario, as they called it, those defaults could jump to 7.8%. Those are, significant numbers. And just to kind of add to the doom, the strategists at the Bank of America were out saying that their in-house credit stress indicator, which measures market conditions, including things like issuance, leverage, frequency of distress and volatility, is now higher than it was in June, which was the previous peak. And they said that that puts it kind of on the verge of what they call a critical zone, adding that credit market dysfunction starts beyond this point. Now, that might explain why, fixed income world and credit world has been a little bit jittery, shall we say. It's not just, to do with the Fed's commentary and what's coming out. Obviously, we've got CPI later this week, which is going to probably be fun. I'm sure Ben's got maybe some thoughts about that. So I just kind of wanted to bring that to people's attention. I'm going to go now into my long idea, which you could say, there are some knock-on effects here in terms of the company that I'm going to present to you guys. So the long idea I've got this week is a company that I'm sure everyone's heard of, AIG, American International Group. They came close to bringing the whole global financial system down a few years ago. So those of you who are of my age, and maybe Ben's a bit younger, but have probably you're probably well aware of these guys from way back when. Anyway, these days, it's a much more, shall we say, less interesting, less exciting company. Market cap, $38 billion. Share price closed around 50 yesterday. So what do? Well, obviously, they're a leading global insurance company, providing property and casualty insurance, life insurance, retirement solutions, and other financial services to people in over 80 countries. They report under 3 segments. So 60% of their revenues come from what they call general insurance, which is insurance products and services for commercial and personal insurance companies. So that's going to be, brands like National Union, American Home, Lexington, AIG Asia Pacific, AIG Europe, etc., etc. So as I say, that's the biggest segment. Then they've got life and retirement, which is 37% of revenues. And that's basically a broad portfolio of life insurance, retirement, and institutional products. And then they've got something called other operations, which is like 2.5% of revenues. And that's kind of some of the legacy stuff that was left over, like deferred tax assets and corporate expenses relating to the reorganization that took place post the GFC. So on the Quants side, we've got 2021 EPS was $5.12. So we've got EPS actually exhibiting a small drop this year of 6% to $4.79. And then we've got predicted growth in 2023 of 30% up to $6.25. Basically, that puts the company on a P ratio for 2022 of 10.4 times and a P ratio for next year on 7.9 times. Dividend yield about 2.6%. Short interest is negligible, just over 1%, and two days to cover. Now, those numbers compared to the sector, you've got, as I say, these guys' earnings predicted to drop about 6% this year. The sector's predicted to drop about 10%, and then the sector growing at 15% next year compared to 30% for the company. The P ratios, you've got them pretty similar, 10.4 for the company, 11 for the sector for this year. And then because the growth is predicted to be quite strong for next year for AIG, we've got a situation where they've got a slight discount to the sector. They're on 7.9 times for next year, and the sector's on 9.6 times. So what's behind the idea? Well, it's obviously a pretty conservative, cautious, in inverted commas, long idea, kind of looking at it as a bit of a port in a storm, looking for a defensive long in that storm that we're right in the eye of at the moment, of persistent inflation, rising interest rates, declining growth, and war. So, whatever you think about the kind of outlook for the US economy, basically whether you think there's going to be a recession or not, business activity is clearly cooling everywhere, but also obviously in the US, and it's cooling faster than inflation. Now, some people will argue that weakening property and casualty insurance rates and costlier claims combined with a modest recession would outweigh the benefits of a rising interest rate environment on investment performance. Now, the way this works is that when you buy an insurance policy, your premiums are invested in various assets. And so, of course, insurance companies globally have been faced for over a decade with very paltry interest rates on bonds, as we know, because of QE and because of zero interest rate policies. So now, for the first time in the best part of a decade, they're actually now going to get some juicy opportunities to find some proper real yield around the place. So investment performance should actually, conversely, in this environment with new premiums, it should actually be positive. The downside is, of course, in a modest recession, you're going to get possibly weakening, for example, property and casualty insurance rates. So it's a trade-off. If there's less economic activity, employment falls, which means also lower worker compensation premiums. However, on the flip side, of course, it implies also that you'd expect fewer underwriting losses, fewer car accidents, less workplace injuries, etc. So net, my bet is that you actually come out slightly ahead on underwriting profit. Now, one thing to remember with this trade as well is that the insurance cycle is not the same as the business cycle. So in the last decade, insurance prices have risen much more than consumer prices. And in fact, the quarter ending June this year was the 19th in a row of year-on-year increases in global insurance composite pricing, according to Marsh & McLennan. The other, the next point behind my idea on why I like AIG is AIG specific. So what I've been talking about was insurance specific, but this is now AIG specific. And it's this thing called the combined ratio. So insurers measure their profitability using this thing called the combined ratio. And how you calculate this is you divide the sum of operating expenses and the costs to settle claims, add those two things together, and then divide it by the premiums earned. And what you get is this thing called the combined ratio. Now, anything over 100% means clearly the insurer is losing money on the risks that it underwrites. And basically with these guys, AIG, for an entire decade post-2007, so post when they blew up, they never achieved a reading of less than 100. From 2017 onwards, through until second quarter of this year, the combined ratio for the general insurance unit at AIG has gone from 117% to 87%. So that's a massive increase in profitability, and a massive improvement in their combined ratio. And that's basically the first time in 15 years that the combined ratio had gone below 90%. So in other words, they've really turned this business around. On the balance sheet, it's not levered. As of the end of June, it was very lightly leveraged, with total debt, including preferred shares, equating to 31% of total capital. The parent company, the holding company, is rated in the kind of lower echelons of investment grade at Baa2 or BBB+. The subsidiaries, which always have a higher rating, are rated at the equivalent of single A or better. So we've got no worries about the balance sheet. And then lastly, in terms of the ball points on AIG, they've just spun off this business called Corebridge, which was their life insurance business. So firstly, they sold 9.9% of it, I think around the end of last year, at a good price to Blackstone. And then last month, they IPO'd the rest of it. This was in September at $21, which was actually the biggest US IPO this year. And they raised $1.7 billion there. Now, the reason why that could be a catalyst going forward is because life insurance businesses tend to trade at a discount rating to property and casualty insurance companies. So if you remember, for next year, we're seeing AIG trading at a bit of a discount to the sector. Now, because they've sold off that life insurance business, A, they're more, it's an easier business now to understand, but B, they're left with the property casualty insurance business. That should theoretically be re-rated as well. So that's part of the story in addition to the earnings growth. So in terms of the last earnings report, that was Q2 on August the 8th. They had a small miss on earnings by 3%. Revenue was actually quite a bad miss at 9.7%. The stock price is down about 5% since that report, having initially rallied approximately by 10%. Next earnings is on November the 1st. In terms of the catalysts, as I mentioned, with the life business being divested, are we looking at what's left being re-rated? I'm betting on yes. And also, crucially, the reason why I think the market saw through some pretty average Q2 revenue and earnings was because the company have said that with the proceeds from the spin-off and the IPO, they're going to step up with their share buybacks. So in terms of the trade structure, it's not a particularly volatile situation with these guys. I'm looking at a $56.5, $57 price target. Near-term vol, strangely, is essentially on a par with longer-dated vol, so there's not really much room to put on a calendar. I looked at some vertical structures as well, going quite long-dated into early next year. Can only really get to just above 2-to-1 on the risk-reward. So basically, I've just gone long of the stock.
Cool. Good stuff. Thanks for that, Jason. Ben, we'll switch over to you. What have you got today?
Yeah, hey guys. I got a couple of ideas. Like Jason said, the CPI number that we're going to get tomorrow can basically throw the whole market off. It's just so up in the air these days. So it's a pretty good idea to stay market agnostic. And in fact, these two ideas are totally unrelated to interest rates. Just kind of trying to not tie myself big to that because it's a bit of a crapshoot right now. Who knows? But anyway, I've been adding Cano Health. Okay, ticker is CANO to my book lately, and I'm gonna get into why I've been doing that. But all I've been doing here is adding calls, guys. Just super simple, just long calls, and I'll get into that. But first, I just want to kind of I'll get into the theme for this idea and kind of set the pace. Okay, so this is a $4 billion market cap company, and they provide medical care for seniors in America, which we all know it's a rapidly growing segment of the global population. In fact, in the States, people are aging super rapidly, and we now have more than 46 million adults 65 years and older in the US. And get this, for the next 8 years, between 2020 and 2030 alone, that's when the baby boomers kind of get up there in age, or the last of them, this number is going to increase by 18 million. So that's a 28% uptick in old people. So in a nutshell, that means that by 2030, 1 in 5 Americans is projected to be 65 or older. So, we're all a bunch of old people over here. And we all got to need some serious medical care, right? And additionally to that, lifespan has been growing for a couple hundred years. And this also leads to stronger demand for senior, specialists in senior healthcare in the future. So I have a graph on here showing the life expectancy going back to 1860. Okay, and it's pretty much doubled from 40 to 80 in 160 years. So I'm not saying it's going to double anytime soon, but we all know, it's on a rise. So even though this growth is going to taper off, we're not going to live until we're like 200 years old. It'll be nice. But the combination of an aging population and increased life expectancy is just going to exponentially require a more and more increased focus really on senior healthcare. So you might say, well, going back in history 160 years to make a point might not sound very relevant for a trade that's going to last like a month and a half. But the reason I brought that up is it's really a necessary backstory that leads into the catalyst for this whole idea. Okay, so just keep that in mind. So if you look at the income statement, we're not going to go too heavily into the quants because that's not the driver of this idea. But just want to point out that this company went public in 2020 and has since managed to double its revenue in 2020 and also in 2021. That growth, though, have been primarily driven by acquisitions. That's why I see the expenses are quite high and operating income is still in the red, as you see on this income statement. but it has allowed the company to really increase its patient base. Okay, so the number of memberships have expanded from 156,000 to 282,000 over the last year, which again is a huge growth segment. But these guys are still not profitable and they're burning a lot of cash. So then what is the main idea or main catalyst really for this trade? It's really an acquisition type of situation. Okay, it's a takeover play. So this stock has been the target of a buyout by Humana, United Health, and most likely actually CVS. Okay, as a potential suitor. And the word is that $14 per share could be the price of the deal. And I have a chart up here. This was from yesterday, Monday, October 10th. The stock closed at $8.60, so $8.60. And when this story started to get some traction, okay, it was on September 22nd, the stock jumped $2 from 6 to 8 and change, and is now pushing towards 10. So the reason why it hasn't gone to 14 yet is because, like a lot of deals, this is kind of rumor mill. It's not done until it's done. So we'll see. But that's how you can do this with options. So one other point I want to make is that besides the fundamentals, there's also a fairly high short interest here. So it's a 12.5% short interest. So what does that mean? Why do I care? Well, because if this stock gets about $10, there's a very high chance that that's where shorts are going to start covering. And that can add kind of a turbo boost to the stock if it starts moving. And so that's one thing, okay, as far as a catalyst. And the other point here is that there's also been major push from various activists or funds that hold shares in this stock. So in March, for example, Third Point Capital, they have a 2.2% voting power. They started to push the company towards strategic alternatives and trying to gear them towards a potential sale. And there's also been other large holders coming out of the woodwork, talking about this company being way undervalued versus its peers, considering the longer term potential, which is what I brought up in the beginning with the aging population and all that. So, there's a big pressure on this company to actually make something happen. All right. So they also stated in August, actually, the management of Kano stated that they are open to all strategic alternatives. And they also hired financial advisors, okay, that deal with this. So there's a good chance something's brewing. So with this stock, the reason why I'm looking at this as a takeover target, we have to keep that in mind, okay, when we structure this as a trade. So, this is a thing that it is going to happen pretty soon, or it's probably not going to happen at all. So, and when it does happen, if it does happen, it can be very fast and aggressive. So I'm going to keep this simple. This is why I've just been kind of accumulating some call options. All right. So if you're looking at this chain, you can pick up the slightly out of the money November 10 calls at 80 cents. So that's $80 per contract. And let's presume you're looking to spend $5,000 on this trade. So that means buying 63 contracts at 80 cents, which is $5,040. And if the deal goes through and the stock jumps to 14 by, let's say, end of October, keeping in mind that this trade, these calls actually expires in November, just to give us some extra buffer. But if it jumps by October, based on an average purchase price of 80 cents, the options will be worth, the 14 minus the 10 strike, which is $4. And there's going to be about 7 cents in time value left. Okay, and we teach you how to figure that out in mentoring. So that's $407 minus the $80 that it cost, which is $327, 63 contracts. So that's $20,600. So that's a 41 reward risk. And the nice thing about that too is, if this happens quickly, you're not kind of dragging your anchor with a short. All right, that's why I would just be long calls in this one. And this can happen next week, next month, who knows? And should a deal fall apart and nothing happens and the stock just stays below 10 by November expiry, you lose the initial $5,000, but that is the max you can lose. So that's a sweet and simple trade that, when we look at these trade ideas, we always have to, it's not like one size fit all. The reason why we are structuring things the way we are depends on the catalyst and other things. So that's the long side of this, but I actually have a short as well. It's not like I said earlier, in this market, but it's just so volatile and sketchy that you kind of want to have both going on. And in this case, it makes sense to pair this then with a most likely acquiring company. Okay, so let's have a look at that. So CVS, which is a big kind of health care pharmaceutical company here in the United States, is the most likely candidate. Okay, and in a case like that, it often makes sense to buy the stock that might be acquired and short the acquiring company, which is CVS, most likely. It's not that CVS is a bad company. They have strong revenue growth. Past 10 years, it's super nice and stable. I have that up on this weekly chart in blue. You can see the trailing sales. But, the stock really had a rough go lately, not only because of Kano, but there were news that the Center for Medicare and Medicaid Services, also known as CMS, they downgraded their Aetna National PPO plan to 3.5 stars. Okay, and that's on top of dealing with a potential acquisition for Kano Health. So what does that mean? Well, the problem with that is when they decrease the star rating, the company will no longer be able to, will be eligible for CMS quality bonus payments, which is a big deal. I'm not going to go too much into that segment, but it's kind of another rabbit hole. Okay, but let's just leave it at that. But this then combined with the Kano deal, that's works, can really put some serious pressure on this stock. And stock already lost 10% last Friday. So how much more downside does it have? Well, it could have probably not a ton, but which is why we're going to structure it the way we are. They also have earnings coming out in early November. And, this is not a stock that usually moves in a huge way, okay, on earnings. I don't expect anything major. But stock is now at around 88. You could very likely get to kind of the 75, 80 level over the next month or two. All right, so we also have a situation where there was like a strong support at 90 that the stock broke, and now it's just kind of hovering around that level. And then obviously, if we get another down leg of the overall market, that's that's not going to help either. So all that said, how can we then structure this to tie it into the Kano Health idea? Right. So, we have earnings and revenue surprise to the upside last quarter. So CVS is a solid business. Okay. So it's not like I expect a huge down move. So this could be suitable then for a vertical put spread. Okay. With the same expiration as Kano. And the reason why I'm saying vertical rather than just buying puts is because, I don't expect a huge move. So we're trying to lower our costs as much as possible, okay, which is what we can achieve by a vertical put structure. And you're going to do this using the same dollar amount and the same expiry. So the November 90 put, when I wrote this up yesterday, can be bought at $5. Okay, and we can pair that by selling in November 80 at $1.50. So the net cost is $3.50, which means that so $350 per contract. Okay, and if you want to spend $5,000, that comes out to be 14 contracts. And the max gain will occur if the stock gets to 80 and below at expiry, and that works out to be the difference in strikes minus the cost, which is $650 times the 14 contracts is 9,100. So that becomes close to 2 for 1. It's actually a 1.9 to 1. So that's not, it's not an amazing ratio. But the difference here is, since we're looking at buying the 90 strike, it's already in the money by a bit, which means it has a higher chance of success. So I kind of have to take that into account when we structure these. And if you're looking at the whole, these two ideas combined into kind of one pairs trade, if this deal happens as planned, the combined profit will be a little over 20 grand. The counter profit will be a little over 20 grand, and the CVS profit will be a little over 9 grand. So the total profit will be about $30,000, okay, in 1 month, and risking 10,000, which is a 3 for 1. So this is one of those things that you kind of have to just put it on, wait it out, and see what happens. But risk is contained, and profit potential is pretty high relative to the cost. So there you go.
Cool. Really interesting one. Jason, let's go back to you. Do you have anything else?
Yeah, I've got a short idea. Got a feeling you guys might have heard of this one. I actually am already short Apple. Market cap, love saying this, 2.25 trillion. They closed around 140 and 42 cents last night on Monday. So I think we can probably skip through what they do. I think we probably know, but what I will say is that the business is divided up into 5 segments. iPhone is 52% of sales, Mac, laptops, computers 10%, iPads 8%, wearables, home and accessories is 11%, and then they've got a services segment, which is the really high gross margin part of the business, which is 19% of revenues. So in services, you've got stuff like the advertising that's sold on their products, their share of App Store revenues, Apple TV, Apple Pay, etc. So the quants, I'm not going to put it in a sector. I'm just going to give you the quants on a standalone basis. So we've got predicted earnings growth this year, according to the gurus, of 8.84%, and predicted earnings growth next year of just shy of 6%. We've got it on a P ratio with those EPS numbers of 23.1 times this year and 21.8 times next year. The dividend yield is 0.7%. Short interest, again, negligible, less than 1%. Days to cover 1.6. So definitely not a consensus short idea. Right, so let's get into the nuts of this. The nuts and bolts, as it were. So basically, the street still expects these guys to generate revenue growth at a rate which is above the pre-pandemic level. So in other words, before lockdowns and stimmy checks and everybody sat at home buying stuff online. So, we're talking about revenue growth this year of 7.3% and next year of 5%. So this is in contrast to what was happening with the company coming into the pandemic, where basically revenue and earnings had stagnated. We know that worldwide shipments of PCs, laptops, tablets had already begun to fall before lockdowns. We know that smartphones, computers, and tablets are mature product categories. I mean, these guys kind of remind me a bit of a short I did ages and ages ago, which was IBM. I don't know whether anyone remembers what IBM was like at the end of the 20th century, but they were the big thing. When you think about Apple, they haven't actually invented anything that they're currently selling since Steve Jobs died in 2011. It's basically all about this services division. So I'm going to throw out a few potential bear points here. So we've got the assumption that, the sort of post-COVID the COVID dynamics continue, which I think is questionable. China. So 90% of Apple's product assembly is in China, and it's also their second largest consumer, so 19% of last year's revenues. They had issues back in kind of 2014, 15, 16 with Chinese regulators, and this led to Tim Cook, the CEO, signing an investment agreement, which we didn't even find out about until the end of last year. Now, this investment agreement with the Chinese government, which they signed in 2016, is $275 billion worth. It's not small. And this, as I say, wasn't even public knowledge until end of last year. And they did that to appease the Chinese authorities. And it's worked because, if you notice what's happened in the kind of the trade war, as it were, between the US and China, Apple has basically remained untouched. So what this investment agreement is supposed to involve is Apple committing to buy stakes in Chinese companies, companies that they don't even have any core business in. So, for example, they invested in DD Global, which is a taxi company. Now, that agreement expired in May, and we haven't heard anything of it being re-signed, and nothing says that if they do renew it, that the terms are going to be the same. Now, also, if you think about that assembly number, China's obviously been affected by their zero COVID policy, so loads of lockdowns this year, and Apple have kind of started to demonstrate that they've essentially had enough of it. So they started building assembly plants elsewhere in Asia, so for example in India and Vietnam. But the problem is that that's not a quick and easy solution. They don't have the same supply chains, and they don't have the same depth of workforce that China has. So it's arguable whether shifting it elsewhere in Asia is not going to affect margins. Also, how do we think the Chinese Communist Party is going to react in terms of how they treat Apple operations going forward? Are they going to remain as generous as they have been? Now, I mentioned this at the start. What if we see a reversion of sales that goes back to the 2019 sales trend? So if we look at where we are now, 2022 net income is estimated that it's going to be 80% higher than fiscal 2019. So in other words, the COVID kind of affected it. Now, if we think about how much higher that is, think about if we reverted back to a pre-2020 situation and what that would mean for the 2023 earnings multiple, which earnings are predicted to go up again next year. It would put the multiple through the roof. What are we seeing anecdotally? Well, we already know that iPhone 14 sales have had a really slow start in China, 11% lower than when the 13 was released. We know that in September, Apple actually instructed Foxconn to idle 5 of their iPhone 14 production lines. We also know that smartphone sales generally have been slowing rapidly in China. So compared to 2021, those smartphone sales generally, not just for Apple, have really slowed in China. We know that iPhones are 52% of total revenues for Apple. And we know also that those sales compounded by 16% in the 2 years leading up to June of this year. So in other words, that was the COVID boost. So basically what I'm saying is pretty much everything's gone their way in 2020 to 21. Net income and revenues essentially went from no growth to unbelievable growth. We've got PC sales alone falling 22.5%. We've got interest rates rising. Why is that of note? Because Apple have actually started to issue debt. I don't think there's any problem in terms of the balance sheet, of course not, but their interest rates will be going up. Why are they doing that? It's to do with trying to repatriate cash from abroad and not having it taxed. Globalization benefits are basically disappearing. along with the Chinese kind of low-cost manufacturing base. We know that everyone loves it, even though it's had a bit of a tough time in the last couple of weeks. Out of the 38 analysts that cover it, out of the 40-odd analysts that cover it, 38 are buys, strong buys, 5 are holds with 1 sell. I think we've got scope here for disappointment. Last earnings report was July 28th for their Q3 because they have a fiscal year which ends at the end of September. They beat on EPS by 5%. Revenues beat small by 1%. Stock price is about 10% since that report. They are going to be reporting towards the end of this month. So, Ben and I mentioned the CPI number earlier on. Once that's out of the way, we're going to get into the guts of Q3 or Q4, depending on when your fiscal year ends, reporting. So that's the next thing that's up, where the people are going to be focusing on. So what are the potential catalysts here? Well, I'm looking for EPS downgrades for next year on the back of disappointing sales. As I mentioned, I'm already short the stock. I shorted it in the last couple of weeks. Unfortunately, it got clobbered a bit last week. I would be, if initiating new shorts, I'd be looking for it to rally up to at least the high 140s. I'd want. Love to get in the 150s, but let's see what happens. Depending on how the results go at the end of this month, as I say, I'm already short of stock, and I'll probably look at doing something on the puts after the earnings because, as we know, the implied vol tends to get bid up ahead of earnings. Plus, we've also got clearly an environment where the general level of the VIX has gone up, and obviously puts a bid because of what's been going on. So at the moment, as I say, I'm going to wait until earnings are out at the end of this month and then decide what to do on the kind of put front.
Good stuff. That was a brilliant episode, gents. Thank you both for coming on the show. There's plenty of information for our viewers to get stuck into over the weekend when they have a look at this episode when it comes out. And speaking to you guys, the viewers, remember, What's on Your Mind isn't the only educational content that we provide at ITPM. There's lots more that we have on our website, itpm.com. We've got courses, we've got webinars, we've got mentoring programs, and so on. So do check out any of those that you might be interested in. I know that we do have a couple of webinars coming up this weekend. You might be a bit late to sign up to those, but there is another one for our alumni students towards the end of the month. That's with Ed Sheck, and that is called Understanding Earnings Growth Profiles Properly. So that'll be a good one. Aside from that, though, we are done today. It's been a great episode. I hope you guys all enjoyed it, and we'll see you next time for another episode of What's on Your Mind.